Friday, October 28th, 2022, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at why the Fed is trapped. No matter what they do, they can't raise rates enough to contain inflation or rising prices. Before that, we're going to look at some economic numbers. The first one I want to look at is yesterday's U.S. GDP for the third quarter. And that came out at 2.6% quarter on quarter for the third quarter. The first two quarters, of course, we know were negative. So the U.S. was in a recession at the beginning of this year. Might have come out. We'll have to wait and see for future numbers. But the interesting thing about GDP, if you look at its formula, is that GDP equals private consumption plus gross private investments plus government investment plus government spending. There is no such thing as government investment. I can tell you that. That's a new thing they've put in there. It used to be just government spending. And then exports minus imports. Of course, the U.S. has been running trade deficits for, 50 years or so. But when government spends almost 50% of GDP, that's what is going on in the States here, 46.18. That government expenditure, and I say just expenditure because to say that governments invest is a total fallacy, because people who invest are people like us who work hard, try to save a little bit, and then risk our capital. Governments don't do that. They just take it from you by force and just throw it around to whoever can get them the most votes, right? So what I'm trying to say here, can you imagine if government wasn't spending 46% of GDP? That GDP number would be nowhere. And the other thing that I would add to the GDP data, and this is not just for the US, I'm not having a go at the US, it happens in the UK and all Western countries and probably China as well, and even Russia. But notice how there's a component called GDP price index, and that's the inflation part that they use to adjust nominal GDP to real GDP. And you notice that second quarter, it was rising at 9.1%. So now all of a sudden, inflation as per the GDP price index is only 4.1. So what that does, it kind of hides the inflation away from that real number. So I would say that number is pretty much meaningless. And this morning we've also had some CPI or inflation data, and the French one was very interesting actually, because what the French government has been doing, they've been subsidizing energy prices to keep them lower, and their CPI had looked very good most of the year relative to the other European countries, but it was expected to come out at 5.7 CPI in France, and it's come out at 6.2. So even the French, they will lose control of inflation or CPI. So now back to the main topic of this video, and it's about why the Fed is trapped, in my opinion. And we're seeing people talk about this, like this tweet yesterday about the fact that the Fed might bring in some pivot language next Wednesday. Their meeting starts next Tuesday and ends on Wednesday. I think the market expects 75 basis point hike. We'll have to wait and see. We've seen Bank of Canada and the RBA in Australia surprise with less than expected hikes. I'm not sure the Fed will do that, but I saw a couple of people tweeting that this here yesterday as well. One of them was Northman Trader, and the other one, I forgot who it was, but this is catching people's attention. And what is this? Well, it's federal government current expenditures, right? But interest payments on the debt. And look at how it's picking up quickly. And why is it picking up quickly? Well, there's two factors, I would say. The debt is rising exponentially almost, and interest rates have gone from 0.3 on the longer end, on the 10-year, to like 4.3 until last week. So, yeah, the Fed is, and the other central banks are between a rock and a hard place because they've lost control of prices, or inflation as they call it. Why do I keep saying prices or inflation? Well, because it was the Fed and the Treasury, just like in all other countries, by the way, that created the inflation. The QE, the money printing, the go direct QE that put a rocket up money supply, M2 money supply, and all the deficit spending by government. That's what causes rising prices. So we're not seeing inflation per se now. We're seeing the consequence of it. So, and all central banks, maybe with the exception of the Brazilian central bank, believe it or not, they held off raising rates and reversing this inflation for too long. And they're still behind the curve because we've got prices rising at double digits. Yeah, in the US, they say it's just over 8%. But if you go back to the way they used to calculate CPI back in the 80s, it's more like 17%. And we still have the Fed funds target at 3.25%. But you can understand now why they're so reluctant to raise it maybe to 15-20% like Paul Volcker did. Well, Paul Volcker didn't have too much public debt to worry about. I think public debt to GDP at the time when he was in charge of the Fed was around 30-35%. Now we're like at 130%. So that's the whole problem there. This interest payments on the debt. Yes, the Treasury can just issue more debt to pay that, but that's not going to be good. That's going to create even more higher prices because when the Treasury and the central bank accommodate, they dilute the currency. They create more and more currency while the economy can't keep up, the real economy, and that's why we're seeing GDP being anemic. And what's the only solution? Well, unfortunately, there's no easy way out. We need to see government butt out from the economy, not just in the US, but here in the UK as well. Our government spending to GDP is more than 50%. We need to get back to like single digits, if not very little government spending as a percentage of GDP. But unfortunately, in this day and age, the globalists, the New World Order, World Economic Forum crowd, and both sides of the aisle mainly, they want the government to be involved in the economy. And that's a shame because it's not going to help us. My only hope is that everything implodes. I don't know if it will be a deflationary collapse or a currency collapse, hyperinflationary collapse. That would be our only hope. But I think this is showing us that it's getting more and more difficult for the central banks to fight inflation. And next week will be pivotal. And no pun intended, actually, but will be pivotal to see what the Fed comes out with. So with that, let's quickly look at the markets this morning. What's going on here? It's 8:15 a.m. London time. We've got spot gold at 1653, down 10 as usual. I've been talking about this, the LBMA. in London. And most people don't realize that gold and silver are traded as currencies, XAU, USD, XAG, USD. And I remember when I started out in the business in Switzerland, we did a lot of foreign exchange, and we had a page on Reuters that was kept up on the monitor, FX, and it had all the major fiat currency pairs. And at the bottom, it had XAU USD, XAG USD. And I asked the guy who was the dealer, because I was just starting out, I said, what are those? And he said, well, gold and silver. You see, they're traded as currencies. And the firm I work for kept positions, foreign exchange positions in gold and silver. So as you can see here, London and not New York is the major trader in currencies, and consequently London is probably the heart of the manipulation of gold and silver. I think COMEX is important, but not as important as the FX market or LBMA. So yeah, we're continuing to see this major assault on the paper price every day this week during London times. It's like clockwork. So anyway, the high in gold has been 1667. The low is 1652. And while they keep throwing paper at gold and silver, the tightness in the physical market continues, especially silver, but also gold to an extent. Silver is down 28 cents at 1931, or 1.4%. The low has been 1930, the high 1965. Yeah, the stock market yesterday, except with the exception of the Dow, the S&P and the Nasdaq were down quite a bit. And then in the aftermarket, markets went further down on bad results from Amazon. So the whole FANGs sector is getting hit hard. I think Amazon was down about 20% in the aftermarket. Right now, the Dow future is down 140 points. NASDAQ 100 futures down 1.2%, 135 points. And the S&P is down 33 points, or 7/8%. To the currencies, sterling is down 0.5% at 115.14. The euro is down 0.2 at 99.40. Yeah, the ECB raised rates yesterday by 3/4 as expected. But the euro dropped quite a bit, and I think the markets perceive the ECB's comments as dovish, because they're starting to talk about maybe a recession and that they would look at rates one meeting at a time. So it looks like they're trying to pare back their tightening. So that's why the euro dropped yesterday, I think. The dollar is up 0.5%. Versus the yen at 146.95. And I saw this story yesterday that Japan is looking to unveil $200 billion in spending package to ease inflation pain. So the madness of the Weimar hyperinflation is permeating throughout the West. Here in the UK, we had a £150 billion package to help keep energy prices low. The Germans have thrown 200 billion euros at trying to solve the cost of living crisis. And now the Japanese, I mean, it's just crazy. So let's continue here. The dollar is up 0.4 versus the Swiss franc at 99.50. And the dollar is up slightly versus the yuan at 725.86. Yeah, dollar's down about 1% versus the ruble, trading around 61. To the other currencies, Aussie dollar is down 0.5%, 64.18. The dollar is up 1/3% versus the Canadian dollar, 136.03, and the Kiwi dollar is down 1/4 at 58.11. Quickly go through the commodities. WTI crude is down 1.6% at 87.22. Brent crude is down 1.3, 93.84. High-grade copper is down about 1.8%, 344.42. U.S. nat gas down 1.4% at 578. Let's finish off with the bond market. Treasury yields have dropped back through 4%. They got down to like 390, the 10-year. Right now we're up about 3 basis points at 397. Quickly look at the UK government bond market. The gilt yields, the 10-year gilt yield is up 7 basis points, just below 350. The 30 year is at 359, up about 8 basis points. So if you enjoyed this video, make sure you hit the like button. Please share far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great weekend. Take care. Bye.